Super. Well, good morning. My name is Spencer Levy. I'm an Executive Managing Director at CBRE, and I'm very pleased to be here today with Joel Braun from Acadia Realty Trust. Joel is the Senior Vice President and Chief Investment Officer, and we're here to talk a little bit about what's going on at Acadia in retail, and talk a little bit about some CBRE events around the same. We're here in beautiful Las Vegas at RECon 2012, and we're here to have a series of interviews with some of the top professionals in the business, and Joel is certainly one of them. So Joel, welcome.
Welcome.
Thanks for coming out.
Thank you.
So Joel, tell us what's going on at Acadia.
We're doing very well, actually. We've recently completed another fund. Mm-hmm. We'll be announcing that shortly, and you know, through all the difficult times, we never got in any trouble. We never really leveraged ourselves to a position where we had any real issues, and we had raised capital before the downturn, so we came out very strong.
Good, good. And so now Acadia, tell us a little bit about your real estate, your footprint, your strategy.
The primary focus is the major metro markets, mostly Northeast. We have a fairly sizable presence in Chicago. We've done a little bit of business down in DC and down further down into Miami. But the New York, the Boston to DC corridor is the primary focus for us.
Great. And how are you finding the market?
Very tight.
Very tight.
Very tight. Strong for core deals, if you're willing to pay. Very tough for everything else.
Sure, sure. So what you're suggesting is that for core deals, hard to buy because cap rates are really compressed, but for the value add deals, it's still a great opportunity if you're willing to go in there. Now, for those value add deals, how are you seeing leasing velocity? Are you seeing the ability to bring in new tenants, or what seems to be the dynamic in those transactions?
Yeah, we see a lot of strength in the leasing market in the core urban markets. We really are struggling when you get to the secondary and tertiary markets, and we are not really interested in buying in those markets.
Right.
And the core markets, while you're looking for value-added assets, the pricing on those assets is expensive. So in New York, for example, or in Chicago, or in Boston, you have to be a believer in the future in order to make the numbers work.
Sure, sure. Now, when we dig into the real estate itself, we found that you know, there's been some big box retailers that are having some issues, but we've actually been having some pretty good success backfilling some of those big boxes that have gone out. The area where we've seen perhaps the most weakness is in the inline space and some of the shopping centers, the smaller tenants. Are you seeing something similar?
Yes, I think so. Right. I think it's generally a struggle, and for the boxes, I think that the stronger markets, the stronger suburban markets, are doing fine. And I'm concerned about the weaker tertiary markets. Right. Where if you look just at the number of stores that each of the different retailers are expanding at, it's just not a great volume of number of new stores. So they're picking carefully very, very select markets that they want to be in. And if you're not in those markets, it's very tough to get their attention.
Now, what do you see what are some of the key factors you look at from a big picture perspective in the economy, consumer spending, price of gas, any of these things that you track as a retail owner, operator, in terms of when you think things are going to change or get better from a retailer's perspective?
You know, I'm not going to say anything intelligent more than anybody else. It's all about jobs to me. And I think that jobs are not only the jobs, but the impression of jobs. So as people get more optimistic, and they get to feel like there's activity, which I actually do feel. I feel that there's much more activity than a year ago, and even though it's slow, I definitely feel the difference. But I think that the jobs is really the biggest issue, and I think it will be for a long time. We'll be interested to see what happens after the next election in terms of taxes. And I think for the sale business, quite honestly, if I own property, I'd really consider selling it now before the taxes change.
Really?
Yeah, I think so. That's my opinion.
Well, what's interesting about your comment, you're the first person, not the first person who said it, but certainly not a lot of people are suggesting that it's time to sell now because of the tax change. But interesting that you're looking at that from your own investment standpoint. Let me ask another question. There are certain markets in which you're now, Northeast may be fiscally somewhat better than, say, California, but you know, New Jersey has its issues. Rhode Island certainly has tremendous issues from a fiscal standpoint. To what extent are those types of issues affecting your decisions on where to buy or sell?
Right. I think again that sort of focuses on the urban markets. For example, in Chicago, we bought a lot of property in Chicago. We think the Chicago market is great. The retailers' feedback to us is that they're doing well in numerous Chicago markets. Just don't go too far out of Chicago into Illinois, where it really struggles, and where the state I mean, Chicago needs money too, but the state is in trouble.
Right.
So I think that the feedback that we usually look for is from our retailers. And the retailers are doing better in the urban markets and expect to continue that way.
Mm-hmm. Mm-hmm. So do you have any sense of when you think things might turn the corner, things might get a little tighter? Because we have, our own internal research suggests that we're not going to get it to call it an equilibrium point for retailers where we have the ability to consistently push rents and occupancy for several years. Would you agree with that, or do you think it's going to happen sooner than that?
No, I agree with that. I don't think it's going to be all of a sudden turning a corner where one day it's not and the next day it is. I think it'll be very slow. And I don't see anything on the horizon that's going to dramatically change that. And certainly not through the next 12 months, in my opinion. So I think it's going to be relatively same store growth. Cap rates, I think, are going to be relatively the same. I don't see them compressing a lot, but I don't see them going up a whole lot. I think that the market is, if you have the right quality, good. If you don't have the right quality, a little bit stressed.
Sure. And so we're all, in this conversation, we're all looking for the factors that will affect our ability to buy and to sell and trying to predict the future. And certainly we're here at RECon today, in part to get some of those answers. But CBRE also hosts an event every year, at which you were at this past year, and I think you've been at prior events as well, the Capital Market Symposium, where you also get some of those answers. What do you think of the event? And what could we do better or different?
What I like about the event is that it's small. And I find that generally, I mean, nothing against ICSC, but the intimacy of that event and the level of caliber of people, in terms of people running organizations, is great. And I do think that you also spent a fair amount of time trying to take us out of our own small world to into international issues and flows of capital outside the country and how they affect us, and capital resources, money flowing to other resource groups as opposed to opposed to real estate. So I think that the scope of it and the population that you pick is very helpful.
Good, and there are several aspects of that event. We have obviously the panels, and we had one panel on global capital flows. Right. We had a panel on funds flows versus fundamentals, which is a topic that we watch very carefully, as many people think capital markets get ahead of the fundamentals. But we also had the networking events. Any aspects of it you thought were particularly good, or maybe we could do differently?
Oh, the answer is all three of those. I think that the issue of money in our business is the single biggest issue. You can lease up any property you want, you can do great things, but the flow of capital is the single most important item when it comes to valuations. Cap rates is what it's all about. You can't, if cap rates change 50 basis points, you can't make that up from leasing. It just is what it is, and that's not that's not an individual level. That's a global issue, and becoming more so every day. So I don't think you can ignore those issues. I think you have to understand them. I'm not sure you can figure them out in advance. I'm not sure that anybody can predict the future very well. So I think in short bites of the future you can get some sense of it. But we do a lot of hedging, and we're always sort of like positioning ourselves so that if things go in one direction, we're okay, and if things go in another direction, we're okay.
Sure, and now you mentioned the global capital flows, and we obviously agree that our business is changing tremendously. How often in your business, when you're out buying or selling assets, are you seeing global capital affecting your ability to be competitive on either the buy or sell side?
I see it in New York in particular, because New York is so intensive when it comes to being a focus of capital investment for the world. I mean, I've learned that over 25 years of being in New York. Every time you think there's a problem, another group of people comes in with a huge amount of capital and buys $90 million apartment buildings, or apartments, individual homes. So I just think that the capital flows is the single biggest item, and we're watching it both with our investors, who are looking at their options of where they're going to invest. Our endowments and foundations always have the opportunity to take their money and bring it into real estate and bring it out of real estate. They can put their money in commodities, they can put their money in stocks, they can put their money in bonds. They don't have to put it in real estate. So we watch that all the time.
Sure. And so at our symposium, would you suggest that maybe next year we spend even more time on global capital flows?
It's very interesting to me. I do think that's and I think that becomes more and more important every year. I really don't see how you get around it.
Right. Well, it's very interesting, and when we look at the values of assets over the last 10 years or so, we actually can break down the difference in value increase from NOI improvements versus cap rate compression. And needless to say, cap rate compression is a much bigger factor historically.
Just mathematically, it's hard to beat. Hard to beat it.
Great. Well, we're certainly looking forward to seeing you again at our symposium next year, which is going to be in Scottsdale. I believe it's February 27th through March the 1st at the Camelback, which is, and we certainly look forward to being there.
Great.
So any final thoughts? What do we think is going to be happening for the rest of this year, certainly in capital markets generally, but specifically in retail, 2012 and beyond?
I think for the rest of this year, you're going to see things the same as they are now. Mm-hmm. I really don't see a huge change coming, certainly not through the election. Mm-hmm. And even after that, another 6 months, you never know. There's always an event that occurs that you can't control. But with things on the table, I just don't see a lot of change. Mm-hmm. I don't see the cap rates compressing a lot, although they compressed, in my opinion, 50 basis points over the last less than 12 months. Mm-hmm. But I don't think they're going to compress a whole lot more. And I don't think they're going to go up a whole lot more. I think it's going to be relatively stable. Mm-hmm.
Well, the 10-year Treasury on Friday, I think it was like 1.7%.
The lowest ever, right.
Unbelievably low. And so long as that stays low and frankly the demand for core retail stays low, I completely agree with you. I don't see cap rates backing up anytime soon. Yeah. The value add is really where the question mark is, certainly our opinion, because right now there's just not enough price discovery, and people frankly don't have enough confidence that when they're going to be able to re-let the vacant space.
Right, except in the urban markets, where there is, we see a lot, we're doing a lot of development in New York, and we see a lot of the retailers picking and choosing their locations very carefully, but to a man, if they're in the urban markets, that's where they want to be. That's where they want to expand.
Well, on behalf of CBRE, I want to thank you for coming, Joel. Great job. And everybody, hope you enjoy RECon, and we look forward to our next conversation with a senior leader in our business just like Joel. Thank you very much.
Thank you.